Fixed trading, a recipe for disaster. That's the topic of today's trading video. Hi, this is Lode with Black Bear Dog Trading and welcome. So many traders rely on a fixed trading method despite time and again not making consistently money, not being profitable consistently. So why do so many traders use a fixed trading system when it clearly doesn't work? And what alternatives do you have? I'm going to debunk this and answer the questions right here, right now. So let's begin. Fixed trading, as the name implies, is simply a method of trading where all the rules that you set in your trading are fixed. For example, you set your stop loss at a specific number of pips from your entry point. You set your take profit at a specific distance from your stop loss. You set your risk percentage at a certain percentage that never changes. Even your slippage is constantly the same. That doesn't work. And the reason it doesn't work is because markets are ever changing. Markets expand, contract, there's uptrends, downtrends, there's low volatility, high volatility, momentum, there is flat or consolidation. Fixed system doesn't work. I'll repeat it. A fixed trading system under those conditions doesn't work. Let me give you a few examples. You set your stop loss at a specific number of pips above or below your entry, but during a high volatility you get stumped out. It happens time and time again. In fact, it's one of the biggest complaints many retail traders have, that no sooner do they enter a trade, set their stop loss, market reverses, and boom, they're kicked out and they have a loss. The same is true for your take profit. Whether you operate on a 1-to-1 ratio, a 1-to-2, a 1-to-3, or even a 1-to-4 ratio, if the market happens to be flat, consolidating, your ratio may never get triggered. And now what happens? You leave, not only do you leave money on the table, if the market were to reverse, not only did your profit not get triggered, but now it reverses and you may end up triggering your stop loss. And again, you have a losing trade. And when you have a strong trend and your take profit level does get triggered, you may actually be leaving more money on the table than what you could have had, because the trend is strong and it continues in its direction, well bypassing your profit ratio. See, markets don't punish you because you're wrong, you made the wrong decision, you used the wrong indicator, the wrong oscillator, the wrong time frame, the wrong currency pair, the wrong broker. None of that. Markets don't punish you because of that. You don't have losing trades because of that. You're being punished, you're having losing trades because you are not being flexible. And that is really the name of the game. You need to be flexible in your trading. You need to be able to roll with the punches. You need to be able to adapt. You see, because the market isn't static. It's constantly moving. It's constantly changing. And so what you do has to change. Your rigidity is what your downfall is. Your constant repeating of the same fixed rules is what causes you to constantly lose and not be a sustainable, profitable trader. And it gets worse than just having losing trades. Many traders say that because of having constantly losing trades, they get frustrated and now they become emotionally devastated. And now many of them will embark on the deadly sin of trading, which is going after losing trades, hoping to recover some of the money they lost, only to make matters worse. Doesn't work. Fixed trading is a recipe for disaster, for the simple reason that it ignores the one constant in markets, and that is change. Change in markets is the only thing that is ever constant. So why do so many traders then use a fixed trading model? Well, the answer is twofold. Number one, fixed trading is easy to learn and it's easy to automate, as is proved by the hundreds, if not thousands, of indicators, oscillators, bots, softwares, EAs, whatever have you, that are all based on a fixed or rigid trading principle. Again, it doesn't work. So what's the alternative? Well, the alternative is actually simpler than you might think. It is called adaptive trading. So what is adaptive trading, you now ask? Well, I'm going to, in the next video, explain exactly what adaptive trading is, but I'll give you a hint for now. Adaptive trading consists of three powerful marketing models that don't just survive volatility, they literally thrive in it. And in the upcoming videos, I will tell you all about it. I will give you the three models, I will break them down one by one, and in the very end, I will actually show you how to trade with those models so that you can not only have an edge, but you can actually become a profitable trader long term. I assure you, you don't want to miss that video, so stay tuned for it. That's it for now. Signing off, Load with Black Bear Dog Trading. Take care and God bless.